Welcome everyone. Thank you for joining me. You're welcome to subscribe to World Affairs in Context on Substack and Patreon for more content and join our community. In the past few weeks, a trio of alleged banking frauds has shaken investors and renewed old fears about the fragility of the American financial system. What began as a few isolated losses, which I discussed before here on my channel, became a broader story, a broader issue, one that's raising questions about whether the banking industry's problems are deeper than many want to admit. So let's start with what happened first. Two regional lenders, Zions Bancorp and Western Alliance Bancorp, recently disclosed that they had been hit by loan fraud connected to investment funds tied to Andrew Stupin and Gerald Marcil. Both banks said the funds borrowed money to finance the purchase of distressed commercial mortgage loans. But according to Zion, something went wrong. A lawsuit that was filed by its subsidiary, California Bank and Trust, revealed that roughly $60 million in loans were misused and that many of the underlying notes and properties were allegedly transferred to other entities without authorization. Stupin and Marcil's attorney insists that the allegations are false, they're unfounded, and that his clients will ultimately be vindicated. But that's not important. That's not what we're actually discussing here in this channel. That remains to be seen, of course, but it is also not important because it was the bank's failure that allowed these loans to be disbursed in the first place, and it was the bank's failure to monitor how the funds and the underlying assets were actually used. And that raises many questions. Now, compared to the recent collapses of Tricolor Holdings and First Brand Groups, which I discussed here on my channel a couple of weeks ago, these numbers might sound small, $60 million. That's change in terms of corporate finance. Tricolor, for example, that was a subprime auto lender, filed for bankruptcy last month, triggering near total losses on some of its debt. And the First Brands Group, an auto parts supplier, collapsed under more than $10 billion in liabilities owed to major Wall Street firms. Against that backdrop, a $50 million or a $60 million charge-off might seem like a rounding error. But the reaction in the markets told a very different story. It shows how fragile the financial system is and how susceptible U.S. regional banks are. Arguably, they are the most heavily regulated financial institutions in the world, and they're very susceptible to massive losses, which may entail their ultimate collapse. And this isn't just about isolated fraud. This is about what kind of risks are still lurking in the shadows after years of cheap money and aggressive lending. When interest rates were low, banks and investment funds chased yield whenever they could find it, from commercial real estate to subprime loans. Now, as the easy money era effectively fades, the true quality of those assets is being tested. Within 24 hours of Zion's bank disclosure, shares of 74 major U.S. banks lost more than $100 billion in market value. Zion's stock plunged 13%, its steepest drop in 6 months, while Western Alliance tumbled 11%. The message from investors was very clear. Even small signs of credit stress can trigger big waves of fear. The panic was amplified by the words of JP Morgan CEO Jamie Dimon, who just days earlier warned investors to brace for more bad news. When you see one cockroach, he said, there are probably more. And he echoed a lesson Wall Street has learned again and again. Small cracks in the credit system often hint at bigger structural weaknesses. Is it safe to assume that there's more bad news? Probably so. It seems that we're just starting to see the entire Ponzi scheme unravel as economic conditions worsen and more uncertainty appears on the horizon. For regional lenders like Zions and Western Alliance, that is a serious concern. Remember, I always say that regional banks have a much lower risk tolerance, so if something does go wrong, they will be the first ones who need a bailout or or they will be the first ones to crash. And this is because they don't have the same balance sheet strength or diversified revenue streams as giants like JP Morgan or Bank of America. Many of them were already scarred by the mini banking crisis of 2023. Do you remember that? When Silicon Valley Bank and others failed under the weight of deposit runs and interest rate exposure. So even modest credit losses can hit much harder now. Another interesting fact that was revealed thanks to the third quarter bank filings is that JP Morgan has boosted its provision for loan losses to $3.4 billion, which is the most since the height of the pandemic. Its 5 closest rivals collectively set aside the smallest amount for bad loans in 2 years, and Morgan Stanley, for example, didn't add anything at all. The split tells a fascinating story about the current moment. JP Morgan is preparing for a potential downturn, taking the cautious route, matching Dimon's warnings about cracks in credit quality. But others, like Morgan Stanley, Wells Fargo, and Bank of America, are signaling more confidence. They argue that the worst might already be behind us and that their exposure, particularly to risky office building loans, is limited. Citigroup CEO Jane Fraser said growth is cooling somewhat, but the economy remains resilient, while her CFO Mark Mason added that the bank is running in a recession-ready mode, yet it feels comfortable with its overall loan book. Now, reducing loan provision increases your available capital, okay? So the Bank of America just lowered its provision by approximately 16% if you look at their Q3 results, and that's wonderful, that's great, that's their management's decision. But what it tells us is that the bank is just searching yields. It wants to use the time to make a bet, and it's betting on being able to issue loans and to collect revenue before things in our economy get even worse. The fact that smaller lenders are taking bigger hits suggests that financial risk is increasingly concentrated where oversight is weakest, in the regional and non-bank sectors that did really well during the easy money years. But the largest banks, with their diversified portfolios and very strict risk controls, seem better positioned to weather the storm, and they are of course being more cautious. We see that with Jamie Dimon and JP Morgan. The coming month will be crucial, I would say. If more one-off credit losses appear, especially in commercial real estate or auto lending, markets may start to view these not as isolated events, but as symptoms of a deeper credit reckoning. And as Jamie Dimon warned, if one cockroach has appeared, there might be more hiding just out of sight. And so that's really the approach that many investors will soon be taking. Thank you so much for watching. I hope that this quick video was interesting and informative. I hope that you consider supporting my work. Become a subscriber here on YouTube, Substack, and Patreon. I would love to see you on my alternative platforms. You will find them linked below. Have a wonderful rest of your day, and I will see you back here tomorrow. Take care.